So how are you? Welcome to our today's lesson. So today I would like us to go through the financial statement of a company, and whenever you watch these videos, the class videos, always put your phone on portrait mode, so you watch as portrait so that you can get clear sentences. So our today lesson is a financial statement of a company, a financial statement prepared by a limited liability company. So we have a small introduction that a limited company come into existence because of growth in size of business and the need to have many investors in the business. So partnership were not suitable for such businesses because the membership is limited to 20 persons. So we have two types of companies. And the first type is the private company, and these have the word limited at the end of the name. Being private, they cannot invite the members of the public to invest in their ownership. Remember, under the Companies Act, Cap 486, we say that a private company is restricted to sell its shares to other members. So we say that the transfer of shares in a private company is restricted. But when you go to a public limited company, there is free transfer of shares in a public company. So in simple terms, we are saying that a private company does not allow outsiders to purchase its shares. So public companies, they are much larger in size as compared to private companies. They have the word public limited company at the end of their name. They can invite the members of the public to invest in their ownership, and the companies may be quoted on the stock exchange. They may be quoted on the stock exchange, and therefore their shares are traded freely. So that is in case you are asked the differences between a private and a public company. So the membership for a private company needs at least 2 members and a maximum of 50 members. For a public limited company, the minimum number of members is 7, and there is no maximum. There is no maximum for a public limited company. So another difference is that we have said that a private limited company, the sale of shares, private company shares is restricted by their articles of association, while the sale or transfer of shares in a public limited company is free, so there is no restriction. So those are some of the differences. So then we go to capital structure of a company, including the initial issue of shares at full price, right issues, and bonus. So what is a capital structure? So when you look at your statement of financial position, the statement of financial position is subdivided into two. The asset side, that is what we call the debit side of the balance sheet. We have the asset side, and then we have the other side of the finance by section. So on the finance by section, we have equity capital and debt capital. Equity capital and debt capital. So remember, debt capital is where we have liabilities. Equity capital is where we have capital, or in case of a company, we have the share capital. We may have ordinary share capital, share premium, retained earnings, We also have other things like reserves. So those are the things that we have on the finance by section, the equity side. So the capital structure is how capital is structured in the statement of financial position of the business. So the term capital structure refers to the percentage of capital, that is money, at work in business by type. Broadly speaking, there are two forms of capital: the equity capital and the debt capital. Equity capital and the debt capital. So you have seen that the equity capital is where you have the shareholders' equity, or what the business owes the shareholders, or debt capital is what the business or what the company owes outsiders. So each has its own benefits and drawbacks, and a substantial part of wise corporate stewardship and management is attempting to find the perfect capital structure in terms of risk, reward payoff for shareholders. This is true for companies and for small businesses owners trying to find or try to determine how much of their startup money should come from a bank or bank loan without endangering the business. So equity capital, this refers to money put up and owned by the shareholders. So that is the owner's equity. So typically, equity capital consists of two types. Equity capital consists of two types. Number one, contributed capital, which is the money that has originally invested in the business in exchange for shares of stock or ownership. Another point is the retained earnings. So the retained earnings, remember, when we have the net profit before tax, we less tax. After lessing tax, whatever remains, we pay dividends. When you less dividend, the profit that remains, we call it retained earnings. Retained earnings. So the profit that is being retained by the business, maybe for future utilization. So retained earnings, which represent the profit from past years that have been kept by the company and used to strengthen the fund, growth, acquisitions, or expansion. So many consider equity capital to be the most expensive type of capital a company can utilize because its cost is the return the firm must earn to attract investment. A speculative mining company that is looking for silver in a remote region of Africa may require much higher return on equity to get investors to purchase the stock than a firm such as Procter & Gamble, which sells everything from toothpaste and shampoo to detergent and beauty products. So in simple terms, we are saying that some companies, due to the risky activities that they undertake, to attract shareholders or to attract investors in their companies, they must pay high dividend in return for the shares invested in. So debt capital, we have said that debt capital is what the business owes the outsiders. Those are bank loan, debentures, account payables. So this type of capital is infused into a business with the understanding that it must be paid back at a predetermined future date. In the meantime, the owner of capital, typically a bank bondholders or a wealthy individual, agree to accept interest in exchange for in exchange for you using their money. So think of interest expense as the cost of renting the capital to expand your business. It is often known as the cost of capital. For many young businesses, debt can be the easiest way to expand business. It is relatively easy to access and is understood by the average American worker, thanks to widespread home ownership and the community-based nature of banks. So the profit for the owners is the difference between the return on capital and the cost of capital. For example, if you borrow shilling 100,000 and pay 10% interest, yet earn 15% after tax, the profit of 5% or shilling 5,000 would not have existed without the debt capital infused into the business. So we are saying that when you take 5% of 100,000 is what you are earning because of borrowing and investing the borrowed money in your business. So in most cases we say that when you want to expand your business or when you want to have a faster growth of your business, sometimes it's advisable to go to debt or to borrow. So types of share capital. So remember, you have two types of shares. That companies deals with. You have the ordinary share capital and you have the preference share capital. So ordinary shares, these are shares that we say that they belong to ordinary shareholders. They carry the voting rights and they also they are the owners of the business, the owners of the company. And the moment the company is making losses, they are the one who suffer most. And when the company make profit or more profit, they are the one who benefit most. So they don't have a fixed rate of dividend, and therefore their dividend is paid if the company make profit, and then maybe after paying all the preference share dividend, whatever remains, if the company does not have a project to invest in which is likely to earn the business more money, the company may decide to pay ordinary shares dividend. So it is not compulsory, or it's not a must that a company must pay the ordinary share dividend. So the terms voting share or common stock are also used in other parts of the world. So common stock being primarily used in the US. So it is called common to distinguish it from preferred stock. If both types of stock exist, ordinary shares cannot be paid dividends until all preferred stock dividends, including the payments in arrears, payment in arrears, are paid in full. In the event of bankruptcy, that is when the business is experiencing financial difficulties, Ordinary share investors receive any remaining fund after board holders, that is the creditors, including employees and preferred stockholders, are paid. As such, ordinary share investors have or often receive nothing after the bankruptcy. Those are the ordinary shareholders. On the other hand, ordinary share on average perform better than preferred shares or boards over time. Ordinary share usually carries with it the right to vote on certain matters, such as electing the board of directors. So they are the one who have the voting right. However, a company may have both a voting and non-voting class of ordinary share. So some shares may be differentiated into different classes. So holders of ordinary share are able to maintain or are able to influence the corporation through votes on establishing corporate objectives and a policy, stock split, and electing the company's board of directors. Some holders of ordinary share also receive preemptive rights, which enable them to retain their proportional ownership in a company should it issue another stock offering. And there is no fixed dividend paid out to ordinary shareholders, and so their returns are uncertain, contingent on earnings, company reinvestment, and the efficiency of the market to value and sell stock. So, ordinary shares are so uncertain in terms of earning dividend. You are so uncertain whether you receive dividend at a particular year. So, additional benefit from ordinary shares include earnings, dividends, and capital appreciation. So their shares will grow. That is one of the advantages the ordinary shares have, that their shares keep growing. They keep earning what we call earning per share, the EPS. So their shares keep earning. But when we talk of preference shares, we shall see that preference shares, they have a fixed rate of return, and therefore their shares does not have the growth. So let's go to the next type of share, and that is the preference shares. Preference shares, they are also known as the preferred stock, also called preferred shares, preference shares, or simply preferred is an equity security which may have any combination of features not possessed by ordinary shares, including properties of both equity and a debt instrument, and is generally considered a hybrid instrument. So preferred stock are a senior, higher ranking to common stock, but subordinate to board in terms of claim or rights to their share of the assets of the company. So preferred stock usually carries no voting right, so they don't vote. So the shareholders of preferred stock, they don't vote, but may carry a dividend, and they may have priority over ordinary shares in the payment of dividends. And upon liquidation, terms of the preferred stock are stated in a certificate of designation. So similar to bonds, preferred stock are rated by the major credit rating companies, and the rating for preferred stock is generally lower, since preferred dividends do not carry the same guarantees as interest payment from bonds, and they are junior to all creditors. So in simple terms, what we are saying is that a company will have two types of shares. Two types of shares will include the ordinary shares and the preference shares. Preference shares, they have a guaranteed rate of dividends, while the ordinary shares, their dividend is not guaranteed, it is not fixed. So let's go to issue of shares. Issue of shares. So shares can be issued being payable for or being payable immediately on application or payable by installment. So there is what we call the fully paid shares. So you pay everything at the time of application, you pay everything. But some shares, the articles of association may allow a company to sell its shares on installment basis. Installment basis meaning on the date of application you pay some amount of application. In case the market price of a share is 20 bob, you may be told to pay 2 shilling during application. Then after you apply, the company will allocate shares to you. So hiyo ndio tunaita allotment. So on allotment you pay maybe 3 bob during allotment. Then later the company will be calling you to pay other installment. Like you may have first call, you pay 5 bob. Second call, you pay 4 bob, depending on the structure that the company has decided to develop. And then that is simply what we call shares issued on installment basis. So issue of shares take place on the following terms. So connected with the price of shares issued at par. So when we talk of shares issued at par, it means that these shares does not have the share premium. Remember, share premium is the difference between the par value and the market price of a share. So the difference between the par value and the market price of a share is what we call the share premium. So if shares are issued at par, then it doesn't have the share premium. So par value is simply the cost price. The cost price, remember in business you have the cost price of an item and the selling price of an item. So cost price is the buying price and the selling price is what the customer will pay. The difference between the selling price and the buying price or cost price is the profit. So when you go to shares, the profit of a share is what we refer as the share premium. So the share premium is the profit on a share. So simply when we talk of shares issued at par, it's like you are selling an item at cost price. So you are not selling at selling price, you are selling at cost price. So you buy an item at 50 shilling and you sell it at 50 shilling. Therefore there is no profit. So that is when you are selling shares at par. You are selling at cost and therefore not making any profit. That profit is what we call share premium. So in this case, shares are issued at a price equal to the nominal value. Nominal value is the other word for par value or cost of a share. Shares issued at a premium, meaning you are now issuing shares at market price. So shares, so maybe the par value or the nominal value is 20 bob. If the nominal value or par value is 20 bob, and then in the market you go and sell that 1 unit or that share at 25. So the shares of 20 bob, you sell them at 25. You are making a profit of 5 shilling, and that 5 shilling is what we refer to as a share premium. Share premium. So shares, share premium, these are shares issued at a price higher than the nominal value. Shares issued at discount. So shares issued at discount, these are shares issued at a price lower than the nominal value. So if the nominal value is 20 bob, remember nominal value is what you are calling par value. So if the nominal value is 20 bob, and then you sell shares at 15 shilling, 5 shilling is the discount. So the shares issued at a price lower than the nominal value in Kenya, it is illegal for a company to issue shares at a discount in Kenya. So accounting entries, so to recognize the amount expected on issue, we debit the share application account at par and we credit the share capital at par value. This is being the nominal value expected on application. On receipt of amount, we debit bank, we credit share application. And that one is being the amount received on application. So shares issued at premium, you're supposed to debit the share application, you credit share capital, and also you credit share premium. So that is being amount expected on issue on receipt. So we debit the bank, we credit share application. This one is being the amount received on application. So shares issued at discount, we debit the share application, we credit the share application, being the amount expected on application. Then you debit bank and you credit the discount on, that is, you debit bank, you also debit the discount on share issue, then you credit the share application. So that is being the amount received on application and discount. Applications and discount. So we have another item known as over and under subscription. So remember, a company may issue 1 million shares to the market, allowing the members of the public to buy. What we mean by subscription. So when the company issue 1 million shares to the market and invite the members of the public to subscribe, then you find that in total the members of the public have applied to purchase 1.5 million shares instead of 1 million. That is what we call over subscription. The shares available in the market is 1 million, but the investors are willing to purchase, or they have applied to purchase 1.5 million. That is what we mean by oversubscription. On the other hand, if the company issue 1 million shares in the market to be purchased by the shareholders or the investors, then the investor apply, for example, 700,000. That is what we call under subscription, because the subscribers have not reached the value that the company is floating to the market. So that is what we mean by over and under subscription. So when a company invites investors to apply or subscribe for its shares, the number of applications will not be equal to the number of shares. So if the apply more than what the company is offering, that is under subscription. If they apply more than what the company is floating or is issuing, then that is what we call over subscription. But if the investors apply below what the company is offering, then that is under subscription. So we have another term known as a right issue. So what is a right issue? So right issue, this is this happened when the company want the existing shareholders to increase their shares in the company. So the company will give them an incentive to purchase the shares, to purchase additional shares at a price below the market price. So right issue is where investors, the existing shareholders, are invited to purchase more shares in proportion to their existing shareholding at a value below the market price. So that is what we mean by right issue. Shares are issued to the existing shareholders at a price below the market price in proportion to their shareholding. Like we have an example. A Limited has a share capital of 200,000, trade up of 100,000, shares of shilling 2 each. So the balance on the share premium is 60,000, and additional capital is raised by way of right issue. The terms are for every five shares held in the company, a shareholder can buy 2 shares at a price of 2.5. Per share. So record the journal entries to reflect the above transactions, assuming that all shareholders exercises their right at the relevant balance sheet. So shares to be issued, so we have 100,000 shares divided by 5 times 2. So the right issue share will be 40,000 shares. So the 40,000 shares will be issued at 2.5. So we debit cash at bank. So what the shareholders will pay, they will pay 2.5 times 40,000. And we credit the ordinary share capital, 40,000 times 2, that is 80,000, and the share premium is 40,000 times 0.5 is equal to 20,000. Then the balance sheet is that on the share premium side we shall have 80,000. Ordinary shares now are 140,000. That is 2 million to 80. 2 million and 280. So we can stop at that point. At that lesson we shall proceed later.